Hello, I'm Mark Starosciak, Managing Partner with Infinium Investment Advisors. This is our market update for November 11th, 2012. As a reminder, anything we talk about today is purely for informational purposes only. It is not a recommendation to buy or sell securities, follow any investment strategy. We don't offer tax and legal advice, and always contact your own financial advisor before making any investment decisions. Well, we finally have one of our big uncertainties out of the way, right? The markets have certainly reacted to President Obama's reelection, and we're getting a lot of questions, of course, on that, the fiscal cliff, and just where we see the markets headed. So we just wanted to give you a very brief summary of our thoughts now that the election is out of the way. So, the markets have not taken too kindly to the Obama reelection, and nearly immediately afterwards they sold off. Now, why is that? Well, I think in many respects the markets, even if you looked at a lot of the survey or the polling data, it was showing an Obama reelection, not by a whole lot, and indeed that's how it turned out. But there was a glimmer of hope from a Wall Street perspective that you'd have a sort of pro-business, pro-economy candidate win in Mitt Romney, and that certainly didn't happen. So part of the run-up recently you could attribute to the fact that the market was trying to discount the possibility of a Romney election, and of course it just sold off and that didn't happen. So that's not saying that we can't have economic prosperity under the next 4 years. It just looked more promising to Wall Street uh, under a Romney presidency. So election day, it's bringing more of the same, really. You're looking at potentially government gridlock, although there have been some olive branches from a congressional standpoint that have been placed forward just in the last several days. Unfortunately, today the president came out and sort of drew a hard line and said, yes, we want compromise, but there's still some areas I'm not going to budge on. So that was certainly a different tone than the congressional leaders had laid out in the last several days. And so the markets initially started off strong today, and they sold off on that news that we might very well be back to gridlock. And really, it seems to be more of the same, and this is not a judgment necessarily, but we can't really expect much different if the same players are on the chessboard in the same places. And virtually that's indeed what's happened here. So gridlock, I think, is a strong possibility. Higher taxes, that seems to be the case. Any compromise deal is going to involve higher taxes. Certainly, we've been in a slow to no growth economy. One would believe that that continues. And when you have a slower growth economy, you probably have little to no growth in corporate earnings. In fact, this last earnings season, Q3 of this year, was pretty lackluster by comparison to the last several years even. So we're definitely seeing a slowdown. There doesn't seem to be much reason to believe that earnings will indeed pick up. So earnings drive stock prices, and when you have stagnant earnings, you probably have stagnant stock prices. And we'll get to how you handle that if our prognosis here is correct. And then number three, we hear a lot about inflation, and that as a potential. People seem to be overly worried about that in our view. So that leaves a potential for more stimulus if indeed we don't get inflation and it remains low. And of course, the Fed is worried about deflation, although the commercials you hear on TV and those believing that all this money printing is going to lead to inflation, it simply hasn't. We are a service economy here in the States. Until you see wage pressure, which is the largest input to costs really for companies here in this country, until you see wage pressure increase, until you see people and companies wanting to borrow money and banks willing to lend, you're just not going to get inflation no matter how much money they print. So we just don't see that. And so the US dollar and gold probably remain in a tug of war, meaning that they're going to be fits and starts, but they probably don't go into a breakout to the positive or a breakdown to the negative in either of those. So that probably continues, which means if you're an owner of gold and an investor in gold, you're probably not going to make a lot of money in it, or the US dollar for that matter. That is a trader's market. We've been talking to you about that in the last several updates that we've published. And then probably unemployment remains stubbornly high. So if you're seeing a low growth GDP type economy, and there's no real reason to hire a lot of people in that instance. So that's really our general outlook. So what happens if we're right? Well, if we're right, and we've been talking to you about bonds and how that could be a bubble. Well, again, in a low to no growth economy, bonds are probably okay. It's the inflation or higher interest rates that would kick that back up. So, if anything, people are and investors are running to the safety of the U.S. markets and treasuries and bonds for that matter. So, prices, at least for now, the next move on the chessboard probably is okay. High dividend stocks are probably okay as well. So, there's been a lot of worry and concern, higher capital gains and dividend income rates going up. That seems inevitable at this point. So, the market, in our view, has already taken a lot of that into consideration. Probably not entirely, and we just don't know what those final tax rates are going to be. But if you look from a stock to stock to stock perspective, if we have a low growth environment, you want sustainable business models and companies that can use their cash flow to fund these dividends. And those are probably consumer staples, for example. People still need to brush their teeth and wash their hair and all these other things. So your consumer staples probably continue to do okay. And number three here is real important. Don't overreact to the potential for higher taxes. A lot of our clients at least have money in retirement accounts, so they're not really going to be hit with higher capital gains tax rates. For those that are, at least in our portfolios, we're not generating typically a lot of capital gains to begin with. So higher rates there don't necessarily mean we want to rush out and sell, all the positions we have that are at a gain, because we're probably not going to sell a whole lot of those over the next few years anyway. But that's something, of course, to look at and talk about with your own financial advisor. And then number four, reevaluating your financial plan. And at this point, it might make some sense to be more conservative in your projections in terms of rates of return. So that for some folks, for some investors, that might very well mean to work longer if you can, to save more and spend less. And I think that's a potential for this environment that we see, at least. So moving down, so we have to look at, what if we're wrong? What if our assessment's wrong? Well, the economy would need to find some way to break out of its funk. Again, with the same players in place, on the same squares on the chessboard, it's hard to believe we don't really see a big impetus for that to happen. And the economy is generally recovering, but the pace of it is really slow. So again, our belief is that probably continues. So bonds would get hurt if higher rates and the dollar weakens, gold would strengthen. But again, we've laid out the case for why. We just don't think that's a strong possibility. But getting back to, if we are wrong and you own a lot of bonds because you haven't liked the stock market, you're going to need a way to bet against bonds or just get out of them, which of course would lead you back to probably high dividend stocks for those yields. And then, if we're wrong, then somehow the certainty of the political landscape would create more investing and risk taking because there aren't as many uncertainties out there. And it's hard to believe that will happen as well because, again, we've seen 4 years where it's been a rather gridlocked situation, and who knows what this next fiscal deal is going to bring. But to get investors to want to take risk and to get just the general population, Main Street America, back into wanting to invest in the markets, it's a virtuous cycle that needs to be created here somehow. And frankly, we don't see what the impetus for that will be. Now, if it develops, of course, you will see investing pick up and you will see investors wanting to take risk. But right now, at least, we just don't see that. So what's our consideration? Again, capital gains management. I mean, if you are harvesting capital gains at the end of the year and doing a tax loss harvesting, you want to continue to do that, and now's probably a great time. Gifting to others and charity. Certainly you want to take care of that here before the end of the year if you have not. And then, of course, we always stress, get that financial plan completed because even now more so, again, if our thesis is correct, you're going to need a sound financial plan to help navigate you through this period of uncertainty and maybe lower returns. With that, I'm Mark Starosciak. Thanks for tuning in, and we will see you soon.